Thank you for joining us today for this webinar dedicated to M&A Trends and Opportunity in East Africa. This webinar was designed in partnership with Africa Legal Network and Boston Consulting Group, and I would like to thank my partners warmly for their support and making this session possible. So my name is Laure Paugam, and I'm the director of the French Chamber of Commerce in Kenya, an organization founded 5 years ago, which now gathers around 110 French and Kenyan companies, often operating across East Africa. Our main purpose is to facilitate business opportunities and networking between the French and the Kenyan private sector. We are part of a broader network of 120 French chambers across the world, and we are also active board members of the European Business Council in Kenya, which is the umbrella organization that gathers European chambers and trade services in the country. So for the past years, it's fair to say that East Africa has definitely been under the spotlight for not only French and European companies, but also all international businesses and investors. Just to give you a quick example from my French perspective, in just 10 years, we have moved from 35 French companies operating in Kenya to around 110 today. And although we do not have strong data available, we know that acquiring a local partner or local company has been the model many of these companies have chosen to set up an office on the local market. This was the case, for instance, in 2013, when world's largest multinational cosmetics company, L'Oreal, acquired Kenya's Interconsumer Products Limited. This was also the case in 2015 when Schneider Electric acquired its local partners, and more recently, the acquisition of Conocobil and Gulf Energy catapulted Rubis to the top of Kenya's retail petroleum markets. So although COVID-19 has brought his fair share of disruption, we strongly believe foreign businesses and investors' interest for the East African region will keep growing. So this session was designed to provide you with more than 10 experts' insights into emerging trends in East Africa M&A deals, the current environment, the key sectors, as well as discuss the changing approach of private equity and venture capital firms in 2021. So in terms of agenda, we will start with the big picture. This will be a conversation between Chris Mitchell, Managing Director at BCG East Africa, and Karim Anjarwalla, Managing Partner at ALN Kenya and board member of ALN. So this will allow us to set the scene in terms of M&A in East Africa. We will then move to a panel discussion focusing on the main trends and opportunities in the region, exploring key markets and business sectors with Dominic Rebello, partner at ALN Kenya, Asif Noorani, Investment Managers East Africa at Investisseurs and Partenaires, Jérôme Katz, Head of Strategy and Investment at MUA Mauritius in East Africa, and Saad Sher, Principal at TLG Capital. This panel will be followed by a discussion on risk management in M&A transactions. What are the existing risks, how to reduce them, how to be prepared. Topic to be discussed will include pre-deal investigations, due diligences, post-deal disputes, fraud, cybersecurity, and the conversation will be led by Roddy McKean, partner and head of corporate at ALN Kenya, with the participation of Rafik Mza, Chief Legal Officer at Afrikinvest, Sarah Ngamao, Managing Director Kenya at Creadev, and Willie Oelofse, Director of Forensic Investigations at ALN Kenya. And we hope we will save time for a Q&A session. Feel free to ask your question in the Zoom Q&A box only. Do not hesitate to target a specific expert, and I will happily moderate this Q&A session at the end of the webinar. Also, feel free to introduce yourself in the chat box. So once again, I would like to thank our partners, ALN and BCG, for making this webinar possible. Thanks to all the speakers for making yourself available to join us today. And thanks to all the participants for joining us this afternoon. I think this is enough on my side, and I will now hand over to Chris Mitchell and Karim Anjarwalla.
Thank you very much indeed, Laure. Much appreciate that introduction, and we are delighted to be partnering with French Chamber and with BCG to present on this very important topic. I hope you can all hear me clearly. I'm Karim Anjarwalla. I'll set off with some opening remarks on really and how the ecosystem has changed in the last 2 years from a big picture perspective. Chris will then lead off on some very exciting data in relation to M&A in Africa and specifically in East Africa. And then he and I will have a Q&A session for about 10 minutes before handing on to the next panelists. So really, there are 5 key themes in terms of the ecosystem. And the first is the impact of COVID. I don't have much time, so I'm going to move relatively quickly. As Laure says, please pop any questions or comments in the chat box. So COVID has had 3 major impacts. The first is that it has precipitated a public debt crisis. And the reason this is important for M&A is that it will lead to the sale of publicly owned assets across Eastern Africa. Sooner, I think, rather than later. And that, of course, creates opportunities right across the space, depending on your area of interest. The second, I think, is that it has made government uniquely listening for different approaches. COVID has meant that many of the old approaches no longer work. And so we have certainly found with regulators that they are much more prepared to listen to new and other ways of doing things. And the third impact of COVID is on really a focus on local supply chains and the need to build capacity locally or at least regionally. So those are 3 major impacts of COVID, and they will all impact entry strategy and M&A in one way or the other. My second key point is in relation to the AFCFTA. Now, you all know that we already have had trade blocs, COMESA, the East African Community, SADC, and so on. But I think the AFCFTA is a game changer in its desire to really ignite inter-African trade. And whilst there are many initiatives that are much spoken about but little acted on, our view on the AFCFTA is that there is real change that it is causing. And we certainly are seeing clients look at their investment decisions through the lens of the AFCFTA, certainly, for example, in terms of where they would locate manufacturing and distribution plants. Linked to this is what I call the battle of the hubs. Right? So I think until very recently, Nairobi was, relatively speaking, the unchallenged business hub for Eastern Africa. There are other cities now making claims to this. Kigali, whilst much smaller, has taken big steps, for example, with the establishment of the Kigali International Financial Center, together with, for example, the partnership between Qatar Airways and Rwanda Air to create a proper transportation hub out of Kigali. Nairobi has also tried to launch its own financial center, and both have international arbitration centers. So how this will all unfold over time, hard to tell, but the fact that these economies are focused on hubs and creating hubs is net a very good thing for the investor community. So that was my second point, the AFCFTA. My third, and I think Chris would develop this, is the impact of venture capital and tech investing. 2020, 1.4 billion across Africa, shared equally between Nigeria and Kenya at about 300 million as the largest recipients of VC funding. 2021 is expected to reach about 3 billion, right? So significantly more. Why does this matter? Well, it matters because we have seen the creation of African unicorns, Wave, Chipper, Flutterwave, Paystack, by way of examples. And in the Eastern African context, Sendi, SocoWatch, Twiga, Laure and Cellulant have all raised north of $30 million. These are all game-changing investments, focused on fintech, focused on logistics tech, focused in some cases on agri-tech. The interesting point here is that although Europe has in Eastern Africa much stronger ties traditionally with East African markets, the leaders in funding this have in fact been American VC, not European or British VCs. So that's obviously something to sort of keep an eye on. My fourth point is the regulatory climate. Lots of changes here. Tanzania, it's like a light, the light switch went on with a change of government. We all know there's lots of hard work that still needs to be done in Tanzania, but certainly investor climate, including, for example, from big mining companies, has completely turned. And we are seeing a flurry of activity in Tanzania, which wasn't the case before the change in government. Kenya, in general terms, I would say the regulatory environment is probably getting a bit tougher in many respects. But what's interesting is that the election is seen very much as a blip. This wasn't true 5 and 10 years ago when major investment decisions were put on hold. This time, we aren't hearing any of our clients say 10 months out, but that we will simply freeze what we're doing and wait for the outcome of the next election. So that, I think, gives you a sense that the overall depth of the regulatory system has improved. My final point is on PE. Needless to say, PE is driving a lot of the investment in M&A in Africa, including in Eastern Africa. The ABCA has some great data, and they recently polled LPs, 81% of whom said they will be increasing their allocations to Eastern Africa in the years ahead. ESG is obviously a major factor and is built in and caked into the mandates of these private equity funds. And what we are now seeing is sort of the virtuous cycle of private equity funds, improvement in governance, and then companies being MNC ready, if I can put it that way, ready to make an exit to an MNC. So those, ladies and gentlemen, my 5 key points. But just before I hand off to Chris, I'd like to make 2 sort of observations. The first is that both Moderna and BioNTech have announced that they wish to construct vaccine manufacturing facilities on the continent, including one in Rwanda. And the second interesting point that came up in the FT was with East African startups complaining about how Microsoft has been effectively outpaying them for software engineering talent in East Africa. Now, obviously, I understand the point of view of the startup community, but it's fascinating that we are in this position, right? That Microsoft can be recruiting 500 quality software engineers into their ADC African Development Center program. It gives you, again, a sense of the depth of talent and human resource available in Eastern Africa. With that, I'll turn it over to Chris.
Great. Thank you, Karim. So as is the occupational hazard, I have, of course, come with some slides, and I have my own sort of 5 observations about the trends driving African M&A, some of which overlap and I think expand upon what Karim has shared, and some of which are new. But allow me to start by sharing with you some data that puts M&A activity into context. So for the period 2017 to 2019, the overall M&A deal value is about $20 billion. If you do follow some of the largest companies in the world, you'll recognize this as being very small compared to even quarterly profits that are announced. So this is an important number, but it's certainly not where we believe it could be. About 500 M&A deals over this period. That means that Africa's share in the value of worldwide M&A is only 1% to 2%. But it has been growing over the period from 2000 to 2015 at 15% on an annual growth rate basis. But the deal value has actually declined. Now, the question, having shown data from 2017 to 2019, is what has been the impact of COVID? This is a picture of deal value shown in the bars and deal volume shown in the line on the left-hand side for all of Africa. And the good news is that it actually rebounded relatively swiftly in 2020 in the second half. And so, yes, it has gone down, but it has not been as detrimental as many feared. If we double click, and admittedly this isn't a full East African view, but it is a view of Kenya, the trend is consistent in terms of both the value and the number of deals being resilient through the period. Obviously, we have this outlier in terms of Vodacom coming in with Safaricom in 2017. But that should give us, some sense that people are still willing in a very, very uncertain global environment to do deals. Now, who's doing those deals we'll come to in a minute. But in terms of the 5 trends that I want to highlight, some of which I think, again, build off of what Karim has shared. There are African acquirers, very stable in terms of the volume, less so in terms of the value, and I'll show you that on the subsequent page. Aligning to Karim's 5th point, PE is important, and I think there is a macro trend or macro thesis that PE can come in, take over a family business, less so state-owned enterprise, although that had been in the playbook previously, professionalize it, scale it, and then get it ready for a trade sale. There aren't as many IPOs as anybody would hope, perhaps, but these trade sales for multinationals, either from the global north or from within Africa, I think give hope and strength to private equity on the continent. Tech is incredibly important. It is much easier to make money out of money. That's why we see fintech being such a big part of this. But it is absolutely showing how technology can drive down costs, drive up efficiencies, which are very important to almost all businesses across the continent and the region. There is desire to have multi-country presence, to have sort of emerging Pan-African platforms. This is also to hedge some of the risks that Karim mentioned earlier, be those political or economic risks, and ensure that there are some synergies. Across Africa, there are very many winning business models, but too many are trapped within only 1 or maybe 2 countries and haven't really been able to expand geographically. And then lastly is the importance of the state-owned portfolio has declined. There hasn't been as much M&A activity here. There may be some outliers as we see in Ethiopia, but overall it has declined. Now, just 2 slides to build this out. This is showing you on the left-hand side the number of deals in terms of the volume, and that's where you get about the 60% of the African acquirers. If you look at this on a value basis, though, those from Europe, North America, Middle East are coming in and doing larger ticket sizes. So on a value basis, we see that number shrink somewhat considerably. In terms of technology, and I think Karim just mentioned that the VC is expected to reach 3 billion in 2021. So this upward trend has continued. There is absolutely the belief that there are many efficiencies to be had across multiple sectors, off-grid energy here. You see the health tech space, the retail or e-commerce space, and of course, fintech, where there has been a tremendous amount of activity. This will likely continue, and again, will be to the point of hubs concentrated around Nigeria, Kenya, and South Africa, and to some extent Egypt, in terms of where we expect to see most of those deals done. So just a few reflections and sort of observations from me, but very happy to engage with you, Karim, and further our discussion on the topic.
Thanks very much, Chris. Amazing insights as usual. I want to lead off because it seems to me that BCG is kind of a bellwether for what might be happening in the M&A space. And I noticed that your data was, I think, tailed off at 2019, right? Certainly from where we're sitting, M&A activity, particularly in this last quarter, is kind of off the charts busy across different verticals, healthcare, financial services, insurance, FMCG, you name it. So I guess my question for you, Chris, is what's keeping BCG busy in this region?
Yeah, so I think there are 3 different types of M&A which we see to greater or less extent. One is sort of the multinational corporation who's coming in and buying a point of presence here, buying local knowledge, market knowledge, buying local talent, buying a customer base. We find a lot are looking around. Obviously, if the deals were done, they'd be in the press, but we find that there are many who are coming and asking for points of view on different sectors. You know, how is the industry trending? Who are the winners in that industry and why? How aligned would this potential target be to their overall core business? That's the first type. The second type is sort of intra-Africa M&A, which is we see companies who have a very strong presence in maybe just one or two countries and want to expand. We do see that. I mean, we've heard a lot about that in insurance and banking over the last couple of years as that trend has continued in East Africa. And then the last is just domestic. I mean, really trying to buy scale. There in so many of our sectors, as diverse as banking to export horticulture, we have companies which are profitable but are subscale and so are not necessarily reaching their full potential. And so, you know, are there ways to combine assets and capabilities to drive more profit? The last thing I'll say on all of them is an incredible increase in the importance of ESG, but even more proactively and progressively, climate. We are really seeing people wake up to the fact that a place like Kenya already is vast majority renewable energy powered. So any manufacture that is done here has a distinct advantage when we start thinking about things like ecological labeling being put onto consumer products. So we are finding, you know, some of the rationale for why to be in a place like Kenya is the strong environmental footprint, particularly on energy. So those are sort of the things that are keeping us busy in this space. I would just close by saying, I think, you know, there are roll-up opportunities. We've seen some private equity activity, but they also need to eventually find exits. And so what we are seeing is these theses have been strong. They've found the assets they want to combine. They've done the post-merger integration, but now they need to actually, you know, take it out to the market. And so that's the last part of this, which is actually making good on the overall investment thesis.
Thanks, Chris. I think what's been interesting about the exit story, certainly in our experience, is that many private equity funds originally came in with the idea that they would list the companies that they acquired and then use an IPO to procure an exit. And of course, you know, other than in perhaps Johannesburg, you know, liquidity is pretty thin, right? And so that hasn't proved to be as easy a route to exit as had been anticipated. But on the other hand, the exit to trade buyers essentially, right, I think has been a lot more profitable because these companies have been made sale ready over the duration of the private equity kind of investment cycle. And of course, the roll-ups, you know, that you talked about. The other thing that I would just sort of highlight, and interesting, maybe you could just perhaps explain why this may be the case. You know, we see very different approaches to financial services, right? So you've got global multinationals piling into the insurance space. You know, everyone from Allianz to AXA and you name it, right? I mean, it's everyone wants a piece of the action, but piling out of the banking space, which has meant that African acquirers in the banking space are much more active. Any thoughts on that sort of particular trend?
Not beyond the generic, which is that insurance thrives on diversity. And so Africa provides a very different profile, I think, for many of these insurance players. And so they are looking for the new pockets of growth and diverse customer bases, be that in the enterprise or in the consumer space. Banking, I think, is, again, both have a lot of regulatory issues, but I think it's that the banks here have very strong positions. As you say, we've actually seen them leaving, right? So they are ceding the ground to the local majors who are just capitalizing on their positions. That's why we see the likes of KCB and Equity and Co-op and CBA. You know, they are very much capitalizing on their position. They're wanting to become, and in many cases are, regional players, not just Kenyan players, although if you actually look at their balance sheet and profit, so much of it is still concentrated in Kenya. But it's very hard for I think it's much harder in some ways for international banking firms to come here and think that they can have a piece of that in the way that perhaps they can with insurance, and that the insurance base, those companies are more ready and willing to do those types of deals than the banks, who are seen to be maybe more politically and economically, integral to the country.
Great. I know a passion of yours, Chris. I just want to quickly turn to agri and agri-tech. I know it's a passion of yours. Creating those value chains is essential. We've seen some interesting deals. I mean, we saw in East Africa recently, Tana Capital buying into QMP, quality meat products, a sort of meat, chicken, and feed business. And there have been others of similar nature. How do you see that space evolving in the years ahead?
Yeah, I think I would delineate between the domestic food system and the international. And on the domestic side, what people are betting is that as incomes rise, the diets will change, and there'll be a greater demand for animal source foods, more consumption of dairy, more consumption of protein, more consumption of ready-made food. That's really what people are looking for. And I think technology is critical to that, because we need to make sure that we have much more competitive prices. The reality is that a ton of tomatoes in California, as I think Peter and Jonjo from Twiga likes to say, and a ton of tomatoes in Kenya, the ton of tomatoes in Kenya is twice as expensive. And we have people in our country here in Kenya, who are spending 50 or 60% of their disposable income on food. This is completely unsustainable. And so there is a almost moral, economic, and social and political argument to invest in the food system, to drive up the efficiencies, drive down the costs. And at the end of the day, we will get into a bit of debate between farmers and forks. Farmers' incomes are always important, but it turns out that as we urbanize, and we're still at relatively low levels of urbanization in Kenya, about 25 to 30%, but there are more forks than there are farmers. And so the price of food, the availability of food, the desirability of food will be very, very important. And for those who have a strong appetite, pun intended, it can be a very worthwhile place to invest. I make that delineation because I think, as we just saw with a recent deal for a rose player just in the past week, Kenya has fantastic potential in exports. It's still far below where it could be. But what has been done in floriculture, and to a little bit less extent horticulture, is very, very exciting. Where we see more momentum, and certainly where we believe we need to have more activity, is in the value addition. We need to break out of the colonial structures of exporting these raw ingredients and have a lot more processed products, at least for wholesale, ideally for retail, so even branded products on the supermarket shelves, particularly in Europe and the GCC. And so we are seeing some more interest in investing into those types of businesses, and in the development community in investing in those types of businesses because of the non-farm jobs that they create. So I think that's going to be critical. And of course, technology will underpin all of that in terms of traceability, in terms of being able to understand weather patterns and the impact of the climate crisis on productivity, and things like IoT to allow us to really understand temperature variability from field to consumer. So all of that is becoming more possible as prices come down and as companies deploy this technology to really get the benefits from it.
Thanks, Chris. Laure, I think we have about 4 more minutes, right? Or am I overrunning?
No, that's right. You can get 4 more minutes, Karim, for our last question.
Great, thank you. So, Chris, I have a ton of questions on agri-tech, and if it comes up, please in Q&A. So don't answer this now, but I'll put it out there. I read data on coffee production. Uganda was amongst the large producers of the world. Kenya was caught in the section that said rest of the world, right? So something's obviously changed in the coffee world. I'll just put that out there for now, and at some point in Q&A, you can perhaps pick that up. But I tell you what I do want to turn to, which is the whole build back better mantra, right? So post-COVID, both our governments and foreign governments are talking about how we build back better. And how that impacts if you are a foreign entity, European, French company looking to enter these markets, how that mantra might impact your entry strategy, how it impacts certain sectors, and just how to think about that build back better doctrine from a strategic perspective.
Yeah, I mean, I think the greatest challenge for our generation is to pursue what we've always tried to do in the last few decades, which is to drive up well-being and prosperity, to have broad-based economic growth. But now we need to do it, in the shadow of the climate crisis. And the great tragedy is the vast majority of funding is going into global north problems, which are around mitigation. We only contribute between 1% to 3% of global greenhouse gas emissions in Africa. So mitigation, electric vehicles, all of these things, particularly in places like Kenya, as I said, it's already 85% renewable energy power. That isn't going to make the difference. It's going to, unfortunately, be about adaptation and resilience. And the reason this is so sad is those who had the least to do with causing the problem are going to be the most adversely affected by it. So I think Build Back Better is how do these companies come, if they want to come from abroad, and really make sure, as I was saying, that they are investing in a way where the majority of the margin capture can be done here, where the skills and knowledge can be developed here, and where the overall structure allows for Kenya to and other parts of East Africa to fund their own development. This again was cited to me recently, but for every 3 shillings that KRA raises, 2 of them go to pay down debt. And so we really need countries like France to think about how do they use the full arsenal of different organizations. How do they use the AFD and Proparco, very active, but also the corporate sector, to work in unison to the benefit of Kenya's development, but also to the mutual benefit of French consumers and French suppliers and French businesses. And I do think it will take all of those instruments. It will take the grants, it will take the debt, it will take the equity. It will take both French suppliers and consumers and Kenyan suppliers and consumers to make this as mutually beneficial as possible. Again, within the challenges of the climate crisis and the need for green growth. So I think a lot of the conversation this week, as it comes up with COP26, a lot of this is what will be discussed, which is how do we go towards trade and not necessarily only aid, and do it in a way which is mutually beneficial, but that for both parties recognizes their contributions and the challenges they face from climate change.
Thanks, Chris. Laure, I think we've just about get to time. I know you've got a big French delegation coming to town. I'm not sure whether it's this week or next. And so I think some of what Chris has said should certainly be passed on to them. Just before I hand over, there's a great question on healthcare in the Q&A. And I think the next panel is probably going to touch on that. But over to you now, Laure, and thank you, Chris.
Thanks very much.
Thank you, Chris. Thank you, Karim. Indeed, there is a big French delegation coming with the French Minister of Foreign Trade and Attractivity at the end of the week. And I hope some of them are participating in this session. Thanks a lot for setting up the scene and giving us the big picture. It's always fascinating to hear your insights on the topic. I think that we will now move to our first panel discussion, and we will hear the voice of the private sector and investors, foreign investors in the country. So we will focus on the main trends, main opportunities, but also the main countries and markets of interest and the key sectors of interest. So I would like now to hand over to Dominic Rebello. Dominic, you're a partner at ALN Kenya, and you will be moderating this first panel discussion. Thank you, Dominic.
Good afternoon, everybody. Thanks for joining us. So we're going to be discussing M&A trends and opportunities in the region. And really what we're going to do is we're going to draw from those 5 trends which Chris has just set out. And we're going to delve into them in a bit more detail, specifically to see if our panelists are seeing the same trends on the ground, whether they see them continent-wide or just in certain specific jurisdictions, and whether they're kind of sector agnostic or limited to specific sectors. We've got a great broad mix of panelists, to include corporates, private equity, and debt financing. Just a very, very quick intro to the 3 of them. Jerome Katz, Head of Group Strategy and Investment from MUA. They're a regional financial services company headquartered out of Mauritius. They predominantly do insurance products, but also offer a variety of services around pensions, investment savings, and stock brokerage. They've had a recent acquisition spree as they expanded from Mauritius across East Africa. So primary place to talk about this from a corporate side. Second, I've got Asif Noorani, investment manager at INP. IMP is an active investment group across the continent. They finance support SMEs across sub-Saharan Africa. And Asif spent 7 years at Phoenici before he joined IMP. So he's got a lot of private equity experience, again, across the continent. And lastly, Saad Sheikh, who's a partner at TLG Capital Investments. TLG invests across a range of sectors, very broad range actually, healthcare, pharmaceuticals, oil and gas, fintech, and FMCG. And they provide both equity and debt financing. Saad heads up their portfolio operations across the continent. So again, very broad experience for what we're discussing. So welcome to all my panelists. I think everyone's video is on at the moment, so they can all be seen. So starting with that first trend, African-led acquisitions on the continent are rising. And really, I think, Jerome, maybe you can talk us through this one at first, because you've had this recent acquisition spree. And I guess the real question is, what's causing this rise? Is it due to increased liquidity from certain African jurisdictions, or is it a better understanding of local risk by African investors when you compare them to investors sitting offshore, in Europe or the US, for example?
Thank you, Dominic. In fact, MUA is an insurance company based in Mauritius, and we are in this 60% of African investors investing into Africa. Our first investment was in 2014 when we acquired Phoenix Insurance, who gave us, in fact, through the main company in Kenya, a strong participation in subsidiary in Tanzania, Uganda, and Rwanda. So we made a regional investment through Kenya. We are an African country, this 60% of African country investing in Africa. And why we are doing this? Because of growth. This is the way to grow. The growth rate in these 4 countries are significantly more interesting than the one that we have in Mauritius, and the penetration rate in the insurance sector is very, very low. So we see the potential of the retail. We see, of course, the potential of the traditional sector and corporate, which is significantly growing, and this is why we came. And in fact, what we did is we reinforced our position to scale, because as you know, insurance is a scale business, through the acquisition of Saham Kenya. So we were also in the figures mentioned earlier when we did the acquisition from another African insurer, Saham. So we acquired last year Saham Kenya, only the subsidiary in Kenya, to reinforce our position and to acquire this critical size in order to scale our business. Then, so this answered, I believe, your question. I would like also to share our experience and on this kind of acquisition. The key aspects, and I believe it's very interesting for other potential acquirers, is to find the appropriate partner, especially in insurance. In insurance, by law, we cannot acquire more than 2/3 of shareholding, and the minority in new markets are very important to keep the business result. So in a traditional segment, perhaps in digital it's quite different, but in a traditional segment, to keep the minorities with us was something very important for us, to keep the business and to help to grow. Because culture and different way of doing business is definitely. And then another comment, which is quite, I believe, interesting for the is East Africa is not one country. We prepared this forum earlier, and we from abroad, especially from Europe and even from Mauritius, we didn't know all the specificities. But East Africa is not one country. We are investing in different countries which are totally different, and the culture, the way of doing business, and you know, in Europe, it's quite easy to understand that the French is not. It's very different from a British or German. So it is exactly the same. So we need to be very careful to understand the dynamics in all these countries. And yeah, what are the minutes there?
Ties into it, because obviously, you know, what you're saying is that each jurisdiction is quite specific. It's not a broad brush approach. I think, Saad, it's a good point for you. You know, the second trend is that there is a rise in Africa-focused private equity, and I guess the question is, you know, you both invest across the continent, but based on what Jerome said, each country is very unique. Each country is very specific. Does that broad brush approach really work from a private equity investment perspective?
It's a great question, Dominic, and thanks for having me. Firstly, to cover a little bit of what you asked about the M&A activity, my perspective is there's a bit of dip in asset prices as well on the continent. So I think foreign capital has chased that. For example, we bought a bank. I know there was a conversation about an exodus from the banking institution, but we did the inverse because of, again, asset pricing. We bought a bank in Uganda at 49%. It's a partnership with Opportunity International, but some kind of great initiatives. But just coming to the latter part, or your latter question, which was around equity, but also asset classes across the continent, and then the geographies. I think each geography kind of comes with its own challenges, its own kind of nuances. So having a broad brush approach can sometimes be a difficult kind of almost a double-edged sword. The reason for that is the lighter nuances, and somebody like Asif will talk about this. There'll be like social nuances, but also commercial nuances, even language, etc. They all need to kind of play a role. And the way that we've done business in Africa is a lot orientated around relationships and trust. And that building of relationship with the Ugandans is very different to how you build a relationship with guys in Rwanda, and completely different with how the Nigerians operate, for example. So my view, very personally, is I think a broad brush approach is difficult. It has to be tailored, it has to be nuanced. Similar to that same idea, we, as you rightly pointed out, we started with equity and then have transitioned out of equity just because of how illiquid equities can be. Chris mentioned trade sales, but trade sales can sometimes be on a hope and a prayer. So if you don't want to live on a hope and a prayer type of model, you want to divest from, our position was to divest out of equity and go into a bit more self-liquidating structure. That is debt, but we still think like equity investors. We still invest like equity investors. It's just the structure of investment is tailored to Africa, very much how relationships are tailored across the various geographies. So I hope that kind of gives you a little bit more context, Dominic.
Asif, anything to add to that?
Yeah, so maybe just to add on a couple of things on there that Saad mentioned, broad brush approach or not. I think the nuances are extremely important. And for example, how you invest in any of these countries, what the level of education is, what the level of talent is, and how you approach investing and change of management or not, or enhancing of management, etc. But not only that, it's a lot of other softer nuances, such as, you know, how, for example, the culture is, you know, is it more direct, you know, or is it more sort of passive aggressive, or is it more, you know, I'm gonna look at it and think about it type approach to many of these things. And that is where a lot of these clashes happen. So for example, if you talk to a Kenyan compared to, for example, just take East and West Africa, some of the big economies. If you take Nigeria and Kenya, for example, very different way of thinking, very different way of handling things. The level of diplomacy or the lack of, or the fact that Nigeria, for example, Nigerians are very direct, Kenyans are more passive aggressive. And if you don't understand that, difficult to work in the area. It's not saying that one is right and the other is wrong, but it's just, a way of understanding how to work and how to build relationships. And therefore, a broad brush across Africa or Sub-Saharan Africa, or even East Africa, for example, just doesn't, to get deals, to work in a particular area, you need to spend enough time, understand the culture, understand the area, and get deep into each of these economies as you invest in them.
So one of the trends which BCG had called out was that African integration makes regional platform plays a reality. But from what you guys are saying, it seems that you need to have an individual approach per jurisdiction, given the idiosyncrasies in each jurisdiction. So how do you reconcile those two? We've got all these trade blocks. We've got EAC. Look at our area here: EAC, COMESA, SADC, and the African Continental Free Trade Agreement. How important is it to you guys as investors to be able to grow an investment across multiple jurisdictions? Or are you just kind of happy to do it as a single jurisdiction investment and take your return based on that one jurisdiction?
It's a great question, Dominic, and if I take that first, our approach is always broader, right? When we go in, even if it's whatever the structure of the investment, we will try to encourage our portfolio companies to look outside of their borders. In Nigeria, be it Ghana, we invested in a business that is aligned with Uber on the continent, and they've expanded from Nigeria to Ghana, now South Africa and Kenya, and now going out of Africa, which is phenomenal for us, that an investment of ours is actually branching out of Africa onto the Asian continent. Similarly, when we invested in Cipla Quality Chemicals, which is an AIDS and malaria drug manufacturing WHO pre-authorized plant, that started selling to Asia its products during COVID. So our approach is always reach beyond the borders. But that need not mean that the same approach that you had in Uganda would be the one that you put into play into Rwanda, for example. As an example, the offtake from the drug manufacturing plant is 40% by the Ugandan government. We sell to 11 governments on the continent, one outside. Out of those 11 governments, one in Southern Africa actually bought $20 million worth of products from us and never paid us back. Now that's an issue that you've got to deal with. Ugandan government, on the other hand, has been very, very timely on their payments. So how do you reconcile to that? If there was a single person managing that entire portfolio, he'd be completely gobsmacked and dumbfounded. So you need that local approach. We're talking to the central bank in Zambia. We're obviously talking to the finance minister, etc., trying to kind of reconcile those issues. But I think even if you have multiple geographies, you can't just have the same management doing everything. You need expertise, local content, local ideas, local execution. And that relationship angle that I referred to earlier is super important, regardless of where you are, whether private sector or public sector, you've got to leverage that. So that's been my experience. Again, all the companies externally looking inwards into Africa should definitely consider the geography, but just have that nuanced approach in mind.
Yeah, I totally agree. And in fact, in terms of investment, we have a global or let's say regional approach. In fact, for diversification purposes. Whereas in terms of operation and management, we have a country approach. And in fact, it's mandatory. By law, we have local regulators. The regulators for the insurance businesses are not regional. It's the local regulator per country. So all the operational management is made at the country level, whereas for investment purposes and for diversification, we think regional.
build on that, because you obviously have a longer term view than the private equity guys. You're in this for the long haul. When you look at a new jurisdiction and expanding out of where you currently are, what's easier? Is it easy to go down the M&A route, find a target in that new jurisdiction and buy in, take them over up to your local content percentage that you can acquire, or is it easier to start a greenfield project?
No, it's easier to focus on M&A and to find someone that's already started rather than a greenfield. The greenfield, especially in the traditional sector, traditional insurance, is very complicated. For the insurtech and the digital, it's totally different. But for the insurance traditional sector, M&A. But for now, we tend to focus on where we are to increase our market share and to focus on these 4 East African countries first before looking at new M&A. We believe that this region is enough to start with, and
I assume, Asif, your approach would be the same. You'd be looking for more bolt-on to grow faster.
Oh, absolutely. I mean, we've got a pharmacy retail franchise in Nigeria, and right now we're acquiring one in Ghana as a bolt-on. So absolutely, bolt-ons are super important. It's the right business acquisition that you have to keep in mind. The partners that you're kind of taking on board, unless you're buying majority or almost 100%, then that matters a lot less. But if you want to expand, you've got to work with partners, at least for the starting point, to help you navigate the local landscape. So absolutely, bolt-ons are very important. Businesses that have a little bit of flex and opportunity demonstrated, they're the ones that we look for from an expansion point of view, be it in the financial inclusion space, fintech, again, acquiring of licenses across the geographies. We support our portfolio companies with that just because of our relationships and the network. So yes, absolutely, bolt-ons are the way to go, at least from our point of view. Setting up from scratch, we've done I think half of that. I wouldn't say one business, because we started, we took over an asset from somebody and expanded in West Africa. We're now in 11 countries. It's again, funny enough, we're all talking about most of my healthcare portfolio, but that is pharmaceutical distribution. But yeah, I did buy it from somebody rather than build it from scratch. So I don't think we would invest in a greenfield or even a brownfield project on the continent. It has to be some sort of growth-orientated development that we'd get involved in.
Let's move on to the next trend, which is around tech and technology startups attracting investment. And I think what we're seeing here is, it's getting increasingly hard to draw a line between what is actually a tech investment and what is really just a more standard investment, which is now tech-enabled. And more so, investments are, whichever sector you're in, and COVID has obviously helped push this. Pretty much any sector and any investment you're looking at is going to be tech-enabled in one respect or another. Now, that tech may be held within the company itself, or it may be purchased in, it may be licensed, etc. What kind of trends are you guys seeing? Are there specific sectors where tech is hotter, or is it really across the field as we see?
Yeah, Sabra, did you go ahead?
Okay, sure. I'm very much into tech, which is why I was excited about this question. So sorry, jumped straight into it. It's a lot wider. Let me explain why, because I think you've hit the nail on the head there, Dominic, because there's a difference between technology-enabled and technology-based businesses. And I think a lot of kind of money just follows a tech idea without demarcating the real cause of it. We as a business will ensure that all our businesses, whether tech-enabled or not, have a tech angle incorporated in them. As an example, we bought this bank in Uganda that I've been harping on about. The reason it's quite interesting is because we're developing a fintech vanilla base as a product base for the bank. We're working with the likes of Branch, with the likes of Fair Money, and all the tech development players in the market, even Flutterwave, etc., to develop that ecosystem. We've done the same with our healthcare and pharmacy retail kind of project. We developed that tech alongside Helium, which is another platform play. So firstly, would we invest in pure tech businesses? Yes, we would. So we invest anywhere from the VC space up to more stable businesses and help them grow. So our capital is growth. Secondly, in our across our portfolio, we then are very, very active in developing that tech across any stream, be it healthcare, be it fintech, which are really the hottest commodities at the moment, at least on the continent, but then the ecosystem, then the logistics, the likes of Sendi, etc., warehousing, data centers, etc., all tech-enabled and tech-led platforms we're very excited about and are really keen to invest in. So our approach may be slightly different to others. We can span across areas that are already tech-enabled versus those that don't have tech, and then help them develop that tech angle, which really kind of then creates opportunities for exits for us, be it equity or kind of self-liquidating assets. But over to you guys. I've given my thoughts.
No, thanks, Sad. So just a couple of things to add to that. And it's true, as Dominic mentioned, and as Sad has just done, that a lot of these businesses are going the tech route, and tech is becoming a more necessity in the entire frame rather than in itself being a value generator. So you could be running a food delivery business, delivering fresh fruits to supermarkets, but how you deliver it and the decisions that you make, and the time to serve, the inventory management, the tracking of your trucks, and how the usage of fuel, etc. All of that needs to be tracked, and the only way to track it properly and accurately and make the right decisions is through technology. Up to now, a lot of these businesses have been traditional brick and mortar businesses. They still remain. I mean, if it's a school, it still has to remain brick and mortar. People have to go to school, people have to go to hospitals, etc. But how you make decisions can be enhanced by technology. However, there's of course a different argument, is that how do you then switch all of these businesses to tech? It's difficult to do that without having a physical component. So it's important then to marry the two. What we've seen is quite a high in valuations just because you have an app, and maybe you're able to lend based on your platform. If you're a healthcare business, you're able to lend some money to patients to get treatment, for example, and that increases the valuation just for the fact that you have something based in tech. And that needs to change. That needs to change. It is going to change over time, but that's something that has been a byproduct of this hype on technology. But very interesting to see on where these things are going.
Maybe we can touch quickly. We've only got a few minutes left, so maybe we can touch quickly on healthcare and tech there. And there's an interesting question from Neeraj around, as African economies are developing and universal healthcare policies are coming into play and becoming more required, what are the changes that we're seeing in healthcare platforms and the provision of healthcare? And I guess that kind of cuts across both the healthcare itself all the way to, Jerome, the insurance side of the healthcare. And do you see potential growth there, given the fact that universal healthcare policies are coming into play? Is it likely to be a hot topic, hot area going forward?
Definitely. There is still some room for the private sector and for clinics and the private healthcare. So there is a big room, but the key and the enabler will be the tech as well, with online consultation and like we have the same for car in Kenya called assessment center. We will have the same for health insurance, online consultation, online prescription, online delivery. This is the way. This is the way. And just to come back to the tech that you just mentioned previously, the tech is the way to go. Tech. We do have any other choice. The only issue that we will have, and that we have as traditional player, is how to make the tech visible. And we see the massive players, especially in Kenya, in food and stuff like that, who are spending a lot of money on advertising. And this is the only way to make it happen. Yeah.
I think just a very quick one is to understand that actually, for entrepreneurs on the tech side, is to really get an understanding of the problem that you're trying to solve. And the problem that you're trying to solve might be a physical problem, but to be enhanced by technology, because the issues that we have in any of these economies are access to food, access to finance, access to healthcare, access to education. But how do you then provide that access with a backdrop of efficiency to reduce the cost using technology, so that eventually you're able to reach many more people, a wider audience, just by being able to reduce the cost at the back end, and that you do by technology. And that's, I guess, how then you marry the two.
And Dominic, with the risk of Laure wrapping me on my knuckles for going over time, I would love to take over this question, because universal health, I think, is talked about a lot in Africa. It's very difficult to execute, and I think this is a pure disruption play, where it needs to go to the grassroots level. You need to get every individual onto a mobile money platform, deducting money on a daily basis almost for insurance, for universal health, universal insurance to work. So that's my 2 cents on that. I can spend a day on this, but yeah, probably shouldn't.
An opportunity for you, Jerome. Something to start.
Definitely. Thank you.
Great. Thanks, guys. We're unfortunately out of time. So Laure, I'll hand back over to you for the next panel.
Thank you, Dominic, and thank you so much, Saad and Jerome and Asif. It's always super interesting to hear from you, because you are on the field and operating with the entrepreneurs. So thanks a lot for sharing your insights on the trends, but also the key sectors and the differences between the approach to the different markets. So we will now move to the second panel discussion on managing risks in M&A transactions. So we will discuss the existing risks, how to reduce them, and how to get prepared. So I'm happy now to hand over to Roddy McKean, partner and head of corporate at ALN Kenya.
Thank you, Laure, and welcome everyone to this final panel of the webinar today. So we're going to be talking about, as Laure said, managing risk in M&A transactions. Obviously, what we're looking to do is to help deliver. We're going to be talking about delivering a successful deal to take advantage of the opportunities that all the previous panelists have been discussing. So I'm very fortunate today to be joined by 3 panelists who've got a lot of experience in this area, and let me quickly introduce them. First of all, I've got my good friend Rafik Mazar, who's the Chief Legal Officer at Afrikinvest, who most of you will know are a Pan-African private equity fund. In fact, Afrikinvest are really one of the pioneers of private equity in Africa, having been set up in the 1990s. So have a massive amount of experience over the years, having done something like 170 investments and carried out over 90 exits over that time. Secondly, Sarah Gamal, who's the managing director in the Nairobi office of Creadev. They're a global PE investment firm operating in a number of markets around the world. and their aim is really investing in businesses who are focused on access to essential goods and services, such as food, sustainable consumption, and healthcare. And then last but not least, we have Mr. Risk himself, Willie Oelofse, who heads up the forensic services practice at ALN Kenya, with many years' experience across the continent, dealing with forensic investigations, fraud, cybersecurity, etc. It's always struck me that Willie is a remarkably relaxed man for someone who deals on a daily basis with the kind of risks which keep the rest of us awake at night. So let's move to the discussion. Risk is obviously everywhere and everything we do in life, and that's equally the case in business. And at every point in any M&A deal and beyond, there's always an element of risk. So understanding how to manage and mitigate it is key in terms of making a successful investment or acquisition. And of course, ensuring that it's a long-term success. So we are going to look at some of these touch points along the M&A process and get insights from our panelists on how to deal with those risk issues. So I wanted to start almost pre-deal, way before a deal's been reached, long before lawyers get involved in the process, because the reality is that the assessment of risk has started long before that and before negotiations have even started. And if I could ask Rafiq just to talk a bit about the processes that you follow at the outset with your risk management hat on in terms of your pre-deal investigations.
Thank you, Roddy, and thank you, ALN, for the invitation, and thank you for the Chamber of Commerce of France in Nairobi for the organization. Very happy to be here today. Maybe before starting, just would like to mention to the French audience that we, as African Invest, also have a French presence in Paris in France, and we also today bring French companies into Africa through our French Africa Fund, sponsored by BPI France and other French and African investors. So I'm very happy here to be with my African and French friends today. And to touch on your question, Roddy, on the pre-deal investigation, indeed, it's very important for us, especially if you want yourself to be Pan-African, and it's not easy to be Pan-African because you need to have local offices on the ground, and you also need to have the right approach for the right country. And it was mentioned before on the previous panel, and especially at African Invest, when we go into a very new jurisdiction or country, we are very careful. Because knowing the industry is something, but also knowing the country is something. And we don't hesitate actually to bring local co-investors with us in the investment, although this means also that we are splitting the ticket and bringing people around the table with us. But for new countries, for example, we've made investment in Zimbabwe or in countries in Djibouti, for example, that we don't know very much, we don't hesitate to bring along with us partners, local partners. In addition to that, we also look at insurance, and I'm very happy to see that there was a French insurer from Mauritius, MUA, on the previous panel, and we look very much to those currency risk and M&A risk, and to see how we could use those insurance products to cover ourselves, I would say. And obviously, having law firms and forensic firms in the due diligence is key in certain aspects. So sometimes, lawyers would tell you you can rely on the indemnities without doing a full-fledged due diligence. But we really go on a very thorough due diligence, and if there's any red flag, we go into forensic reports before investing. So in a nutshell, pre-deal structuring and knowledge of the country is key, in addition to using experts, and forensic experts sometimes is very important.
Great. Okay, thanks, Rafiq. And I mean, I guess here that really at this point, we're kind of talking about people risk. It's getting to know the people you're dealing with and feeling comfortable that your interests are aligned. I mean, Sarah, I mean, I assume you follow a similar process, but perhaps you can give us some thoughts on that.
Thank you, Roddy, and I will echo the same as Rafik. Thank you to the ALN network and to the Chamber of Commerce for the invite. I think it's a very pertinent discussions today. And maybe just to tell a bit about credit, we are actually entrepreneur-led or funded. We are funded by a highly entrepreneurial family from France known as the Willie family. They are behind Decathlon, Lopamela, and a few other retail companies. So as you can tell, we are because we are entrepreneur-led. There's also big focus on entrepreneur in this pre-deal investigation stage. So we try to focus on the background of this entrepreneur, how establishing whether there's a strong chemistry and really understanding their DNA and whether it's a fit with us. And of course, on that, we also will try and echoing Rafik here, looking at local networks that also can be a reference or a referee to these entrepreneurs. So I think this is an important part, and it comes even before the deep diving into data rooms and deep diving into financial models where you deconstruct and reconstruct them again, which are also anyway pre-deal investigation processes that we get into. And during that stage on at least the technical part of it, we are also trying to establish the commercial attractivity of the business, establishing what are the key drivers and what are the risks surrounding those key drivers. So those are some of the things that we'll focus on. And I think just back again on the entrepreneur point, what we have seen before, have had experience where an entrepreneur came to us with their own dirty laundry list. Of, okay, guys, I know you're going to do a search on me. You're going to try and establish who I am and also on my business. And so they came to us with a dirty laundry list of all the things that maybe have happened in the business that they would want us to know way ahead of time. It's almost like a preamble to a disclosure schedule. And we found that quite interesting and quite actually beneficial for us, because then you're going in with your eyes wide open and you know where to focus on during the due diligence phase. So in fact, for us, we have tried to find how do we then incorporate this kind of disclosure to really manage the entrepreneur risk or even the business risk for that matter.
Yeah, okay, great. Thanks, Sarah. And Willie, I mean, I know you're involved in a lot of these pre-deal investigations. Is there anything you wanted to add on that?
Yes, Roddy, thank you. Other than Sarah, people normally don't come with a laundry list to us. We actually have to find it. So Roddy, yes, we look more on the ethical side. So when teams are approaching us to do background searches on individuals and entities, we're really trying to find any adverse media, any negative media, or any negative connotation to the individuals and or the entities. Also, I think it's fundamental to, when you do these type of things, to be local, because local, we understand the links, we understand the ultimate beneficial owners and the likes, and eventually I think those are the things that really makes a difference when you decide to go forward.
Okay, so having been through that process and kind of now decide you want to do the deal, you go into the formal due diligence stage. You've appointed your advisors, you're starting off on the DD. At that point, there's often a lot of pressure to move quickly, often from the seller, the target, potentially competitive bidders. But at the same time, you want to kind of focus on the DD. I mean, Sarah, how do you make sure that you're kind of conducting an effective process where things, you're doing the diligence that you want within the timescale that's going to ensure that you're kind of protected?
Thank you. I think in the context we like auction deals. So let's start by saying the benefit of an auction deal is that it comes already with an investor-ready kind of pack. The entrepreneur has been prepared by an intermediary. The business has more or less been prepared. There's data rooms in place. So I think from that perspective, it's quite beneficial to have, you know, a structure around getting an investor. But I think where most investors do not like to, you know, be involved in is the price kind of auction, the price bidding part. And I think the way we go about it is really to show our value add as creative to the entrepreneur, so that they want you to come on board because of the value creation that you can bring, because of are you going to help them to expand into new markets? Are there certain aspects of their business that our network, because we leverage a lot on the entire network of the Willie family, which is over 200 companies, logistics and supply chain. So those kind of things that we can bring on board, then the entrepreneur can see that value that we can bring, and the timeline stops to be the issue that they're hacking on. Like, you know, we have a scheduled timeline within which we have to complete this. We do try, of course, to have a timeline, and we will be very structured, including having a project management tool to show all the different steps from when we have started talking to when we will close a transaction. And then, of course, after that, you have a 100-day plan afterwards. But we are structured in that perspective, but very early on, instead of getting into an auction process of timelines, and this is when you have to give us your timesheet and we have to then come back to you, we really get around that by showing what value we can bring on board. And then you want us despite the timeline.
Yeah, so being super organized. And I mean, I guess, Rafiq, that auction processes are, because of their nature, likely to increase the risk issues, given the competitive pressures and tight deadlines.
Yes, absolutely. We see that sometimes you can find even the SPA, the share purchase agreement, in the data room, and the seller would tell you, look, it's a take it or leave it, and you have 1 week to give me your price proposal and your markup on the purchase agreement, and that's it, you know. And we see that in especially in France. If I give the European example, where these transactions happen very fast, and there is a co-investor coming, and we come as co-investor, but we also see it more and more in Africa, in more and more intermediated transactions with investment banks increasingly involved in those transactions. And yeah, as mentioned by Sarah, we also try to make the deal proprietary and not only intermediated, so that we are spotted by the sponsors or by the target company, and our added value is recognized beyond the price, because the price is one element of the transaction, and having even the environmental and social component, having the network to bring that company to the next level and to make it an African champion or regional champion, bringing the economic expertise, the country expertise is key. So it's a kind of seduction process that we want to transform from a pure technical and pricing process to a seduction process. And if the chemistry works, indeed, this what makes the perfect transaction. I have one anecdote maybe to mention. In one of our Algerian transactions, we've had we were negotiating a long time with a sponsor, and then we had another institutional investors coming, and from a very rich region of the world, and the sponsor said that he had the envelope of the offer, and he's never opened it actually. He didn't even want to see the price that investor was willing to pay. So hopefully we cannot do it for all the transactions, but if we manage to build the relationship with the sponsor before that, that's key.
Yeah, that's very good advice. Developing those relationships is often key to the success of the transaction. So Willie, one question for you relating to due diligence. I mean, I think, as you know, as a law firm, we've seen an increase in post-deal litigation over the last couple of years, with warranty indemnity claims, etc. What does that suggest to you in terms of how investors should be approaching the whole DD process?
So, Roddy, I think just to start off this discussion, I think we have to go back. So the way I got involved was really from a reactive point of view. So a specific transaction went south after close, and then we've done a forensic investigation. Eventually, we unearthed that they overstated revenue by 500-600%. And after our investigation, reviewing all the documents, the reports, and the likes, in hindsight, I can say that if people really read all the DD deliverables, legal, tax, financial, environmental, I think they would have seen the red flags. So what I've learned from that is the first thing is that you almost, what we bring to the table, being forensic and compliance, is that we look at some of these reports with a different lens. And then when you look at a report with a different lens, it's sometimes not the specific report, but it's actually stitching the report together, where you identify the red flags and potential risks. Very recently, we've been helping a specific client to do exactly that. I don't think this is very common, but where they ask us to actually lead the process and to take all these consultants, first do a risk assessment, brainstorm the risk with the various consultants, the various work streams. What we've done then was to update the checklists, the DD checklist and the likes. And then initially, obviously, as you know, Roddy, the lawyers won't like this, but initially there was some pushback, but then everybody started contributing to that, just making it more efficient and more effective. We then eventually end up at a place where either some of the consultants did additional work, or we as the team then delve deep in some transactions and the likes to make sure that we cover all the risks. So I don't think this will work with all transactions, but definitely where there are specific high risk, I think this is a potential solution for that.
Yeah, no, that's a really good suggestion, Willie. I think we can all learn from that and can think of circumstances where that could really be beneficial. So I want to change tack slightly. I think we can't discuss the whole issue of risk without touching on things like currency risk and political risk, external factors such as those. Rafiq, I mean, you're obviously investing in a lot of different countries, all of which are different. Those kind of issues need to be dealt with in different ways. What are the particular challenges that you faced over the last few years?
Yeah, this is a very wide topic, but you know, for example, you know very well in certain countries like Ethiopia today, we have some foreign exchange challenges to repatriate dividends or capital gains. And to be honest, those challenges have been a hurdle for us to expand and to make more and more investments. And we are looking for appropriate coverages like the repatriation of foreign exchange insurance that are too expensive for the moment, honestly, to make and no one can predict actually how the currencies will evolve. So today there are no financial products really that can address, at least from my knowledge and from our knowledge of the market, that would have a reasonable cost to address that challenge. Although in other instances, there are some developing financial institutions who can provide for those insurance products, such as the World Bank through the MIGA as a company, or other private insurance companies who can provide for PRI, so political risk insurance. We've used one for Libya, and we were fortunate to have had that political risk insurance in the Libyan context that covered our investment after the revolution in Libya, and we definitely look for those products in conflict or post-conflict countries in Africa. Currency and political risk is key for us, and sometimes, unfortunately, we pass on transactions for that.
Okay, I'm very conscious of time. I know Sarah's nodding, so I suspect she may want to say something, but we're quite short of time. There's a couple of 2 or 3 other topics I want to cover, really to give the whole risk picture a good airing. Sarah, can I turn to you to talk about COVID? Because we can't ignore it. It hasn't gone away in the way we all hoped. And I know that for a lot of last year, private equity firms were focusing on ensuring that their portfolio companies were dealing with the impact of COVID. But I think what would be interesting for the audience would be for you to talk about what lessons you've learned more broadly from the experience of COVID and what you went through last year in terms of how you evaluate risk and what you now look for when you're analyzing a potential investee company.
Yeah, no, thanks, Roddy. So yes, of course, we went through a very unprecedented time. Well, immediately now it feels almost like we have, kind of settled into the fact that COVID is not going away as soon as everybody anticipated. I recall immediately after, all the lockdowns began, the first thing that everybody did was to focus on their portfolio companies and what the kind of impact that COVID will have on them. And I remember running so many Excel scenarios of, what happens if if these lockdowns go for 3 months, if COVID lasts for 6 months or 9 months. And I think even at the time, our longest period of anticipation was 18 months, and it looks like it might be even further than that. So of course, a lot to be learned. I think for us, we were quite fortunate to be in the different markets, which were kind of hit at different times. We have an office in Shanghai in China, for instance, and that of course was the first market. And we had lots of lessons learned by the time it was getting to Europe and going to the US, and then finally really having massive impact in Africa. And we leveraged a lot on what was being done in those markets to see what is applicable for us. I think what it advised us going forward is, I think we were very fortunate in the fact that our mandate is to invest in essential goods and services for the many, so food, healthcare, education. So in essence, we invest in what will be needed regardless of this kind of a calamity. But of course, it did mean that for some of the entities, even in those sectors, they have to rethink how they do business. We did, for instance, invest in an education company, and education during the time of COVID. And as you know, this was massively hit during the time. But what helped for us was that this particular target was already doing blended learning. So by the time they're going into lockdowns, this is part of their pedagogy. They could really still continue to disseminate education through their virtual programs, and so they were already well lent to manage this calamity. So I think going forward, we are now looking at what resilient businesses that could be resilient against this kind of pandemics, and also looking at disaster preparedness. So part of the early day due diligence is really to look at, do they have kind of disaster preparedness, or have you even considered kind of having those in place, anticipating? Of course, you don't have a crystal ball to see the future, but you need to have some level of anticipation of those kind of situations.
Yeah, really interesting. Rafiq, was there anything you wanted to add on that issue?
Yeah, on COVID, really, what rose from COVID is that we spent the first 6 months during COVID period going back to our force majeure clauses and see, the impact of those, of any major problem on the contract and on the contract management of our different, of our 170 portfolio companies and all the agreements we have. So having effective contractual management tools and studying the impact on the different contractual obligations of each of our activity was key. And it was quite surprising to see the difference between the civil law countries and common law countries' treatment of force majeure, where we had under French law regulation a more protective legal system, whereas in common law countries you had to have a contractual force majeure clause to actually be able to enforce it. So that was also one of the funny parts of our COVID times.
Yeah, very true. Under common law, we don't have that concept, and therefore you need to have a specific clause dealing with it to be able to take advantage. I mean, there are other remedies such as frustration, but otherwise it's not quite so straightforward. So we're kind of quickly running out of time. There were lots of other areas we were going to talk about, but perhaps on the final topic, we can just talk about the fact that risk, of course, doesn't stop when you close your deal. It keeps going. So it requires continued oversight of the investment of the acquisition. Willie, do you want to give some thoughts on that? Because I think that's often where you come in terms of advising clients.
Thanks, Roddy. Yes, once again, 2 or 3 things from my side. The first thing, I think also COVID taught us this as well. During the pandemic and during a crisis, fraud, economic crime, leakage tends to increase. I mean, we've seen that with various of our clients and in all sectors. And what I've seen was the ones that are taking a more proactive approach are the ones that are actually, they've done much better. So you can't try and fix it after the fact. It's a process. It's putting a compliance program in place and chip away on it. And then when it goes wrong, you are prepared to deal with it. The second point, and I know we are out of time, Roddy, but the second point, and I think probably the most important, is cyber and the cyber threat that we're facing right now. The previous panel discussed technology. COVID showed us that working from other sites of location, that increases our risk significantly. There's not a week passing where our financial sector, whether it's insurance or banking, are not dealing with cyber incidents. Law firms are dealing with cyber incidents on a daily basis. All medium and small businesses are facing this risk, and we're hearing about it on a weekly basis. So this is a significant risk. It's something that I think everybody underestimates to some extent. And we can talk long and hard about what to do about it, but I think the main thing is we must identify that, we must talk about it, and then we must work out a way to manage that risk going forward. But it's definitely a significant risk.
Thanks, Willie. So we're just almost out of time. Rafiq, Sarah, any final comments from you before we wrap up the session?
Yeah, I would only agree with Willie to say that people tend to focus too much maybe on the investment period for compliance and for those kind of KYC checks, but really it's really important to have tools to monitor the list of your, for example, service providers or partners or clients, to make sure that there is no one in a new list of sanctions, there is no one that is on a non-compliant jurisdiction or activity. So this is a whole topic that needs really to be addressed.
Thanks, Roddy.
Yeah, I agree with that, and I would say I think you need to be creative. I think sometimes as a fund in going further in identifying risks that you probably were not thinking about. I think sometimes we also try leverage a lot on resources that are typical or traditional, like registries, and what we discovered actually in the past is that sometimes, especially in sub-Saharan Africa, they don't work as efficiently, and there will be matters that are not captured in those registries concerning entrepreneurs. We had an instance where we found that an entrepreneur had actually pledged the company that we were investing in, this is in my previous life, to the government for a privatization project. And this was nowhere, you could not find this information. And for some reason, they didn't think that it was pertinent information to give. But I think so. Be creative in finding ways to get as much information as you need and identifying potential risks very well in advance.
Great, thanks, Sarah, and thanks everyone. Fantastic insights from all of you. I hope that's given everyone some interesting thoughts about how to more effectively look at risk. I'll now hand back to Laure for the Q&A.
Thank you very much, Roddy. Thank you, Sarah, Rafik, and Willie for sharing these excellent insights on risk management. So I can see that there are no Q&A in the Q&A box. I'd like to think that is because we gave such a comprehensive overview of the topic that there is no more questions to be asked. If you want to ask a question, I will give you 30 seconds to type your questions. Otherwise, I will hand over again to Roddy for the closing remarks of this session. On my side, I would like again to thank ALN and BCG for partnering with us on the organization of this event. Thanks again also to all the panelists who have agreed to share their precious time with us so they can share their insights. It was for us a super great opportunity to be able to listen to you. So Roddy, as I see no questions appearing in the Q&A box, I hand over to you for the closing remarks and the end of this session. Thank you.
Thanks, Laure. We've clearly stunned everyone into silence. But perhaps I can just echo my thanks to everyone who attended today. I hope that you go away feeling that you've learned something new and has challenged your kind of way of approaching investment. Thank you, obviously, to our partners, the French Chamber, and to BCG for partnering with us on this great webinar. Thanks, obviously, to all the panel members for sharing their experiences, and to my colleagues who led the various sessions. And then perhaps finally, I'd like to thank my colleagues in our BD team, Carlotta, Anthony, and Christine, who pulled all of this together. And I think without them, it would never have happened. So you're the unsung heroes of this particular webinar. So thank you all very much. And I wish you a good afternoon.